So let's talk about the oil market, specifically the U.S. oil market. There are more signs and more stories that the U.S. shale oil boom is fizzling out, and there is going to be a big bust in the near future, probably in the next couple years, 2 or 3 years, perhaps even sooner, depending upon the oil price. And there's been some very interesting oil stories that have come out in the last 5 days or so, give or take. So the chart that you guys can see on your screen there is that there's been a lot of shale oil production, and now the U.S. net imports of crude oil have dropped a lot. And this chart is from October 11th in the Wall Street Journal. But it's somewhat misleading, though, because I asked my friend, a former coworker, when I was working as an oil and energy analyst, and oil and energy expert for over 3 decades, Robert Rapier. Robert's been writing about oil, covering oil, working in the oil industry as an engineer for over 30 years, I believe. So he has massive experience. I've interviewed him many times over the year in the archives of my channel, and I showed him the chart, and I wanted his opinion on this. And he said, yes, he guessed it's technically true, but we're still net importers of crude, and we wouldn't be if we weren't exporting finished products. And the chart is of net imports, so the U.S. still imports about 9 million barrels per day. But the bottom line with shale oil is that the U.S. has massively increased its oil production, and a lot of it in the last decade has not been done economically. It's not been done efficiently. It's been misallocation of capital. The pension funds, the other investors that were expecting dividends, that were expecting earnings, that were expecting free cash flow, for the most part, except for rare companies, especially publicly traded companies like EOG Resources, they have not gotten that. So oil production has been grown, and some people think that this is because the U.S. wanted to maintain strength with the petrodollar, that if they increased oil production, even if they subsidized all of it at a loss, that this would prevent loss of the petrodollar. I don't know if I believe that, but there's a lot of people that do believe that. But over the last few days, there's been a lot of interesting oil articles that have come out besides just this chart. So today, on Wednesday, October 16th, we got an interesting, before I talk about some of the articles, let's just talk about oil stories. So the oil market today on Wednesday, October 16th, 2019, the WTI crude price is looking very weak, not even holding $53 at $52.98. Brent crude is back below $60 at $59.11. So the oil market is looking very weak. In my humble opinion, this is a combination of factors. One of the major factors is a slowing global economy. There is just enormous amounts of data, tons and tons of different data points that the global economy, emerging markets, China, the major exporters, exporting countries, those numbers are all down, slowing very, very rapidly since 2019 started. And on top of that, with the oil market, you also have the data that came out today. Props to Shy Girl. She is on Twitter. She is a futures and options trader for energy, stock market, metals, currency. And she's at CHIGRL. She's been interviewed by Eric Townsend on Macro Voices, so this is just not some random person. She covers the crude oil market extensively because she trades oil futures, so you can follow her. And she put out the inventory build that was announced today, and there was a very big, I looked up the article on this, to go along with this. There's an article from Julianne Geiger. Remember I told you that oilprice.com is, in my opinion, the best free resource to learn and research the oil market. And Julianne Geiger has an article out about the supersized crude oil build today, sending oil prices down. So remember I said that one of the things that influences oil prices, especially short-term focused oil prices for oil traders, is inventory numbers. So if there's an inventory build in the U.S., either at Cushing area or Cushing, Oklahoma, I believe, or the American Petroleum Institute, API. And the American Petroleum Institute, or API number, the amount of oil inventory. So this is the amount of oil that the shale oil companies, guys and gals, are producing massive amounts of oil despite the oil price falling. They're actually still increasing. There's still massive inventory build. The inventory build for crude oil here in the United States, it was way above expectations. So analysts expected only about a $2.878 million a 2.878 million barrel, not $1 million, million barrel inventory build. And these are people that spend full time tracking these things, these analysts. And the number we got was around almost 4 times as much, 10.45 million barrels of extra oil inventory for the week ending October 10th. And so I believe last week there might have been there was another large oil inventory build too. So a large crude oil for the last week, it was 4.31 million barrels, and the estimates were only around 2.9 million. So 2 weeks in a row, and last week there was a big surprise for crude inventory build, and the week ending October 10th was even larger. So what this means is, despite the oil price falling in WTI, the shale companies are running full blast. And this goes to the bad economics of shale and how these U.S. shale oil producers funded themselves. They funded themselves by promising free cash flow, promising dividends. For some of these CEOs have been promising dividends of publicly traded shale companies for 10 years now. And it's never come, or it's only come for a quarter or two, at most a year. And yes, the shale companies have been able to reduce costs, and that's what's kept some of them in business from going bankruptcy. That's why you haven't had all of them go bankrupt yet. But there was another chart I was looking at where there is a rise in bankruptcies. It's still rising, and very interesting, and this is why I wanted to do the show today. The Wall Street Journal just put out another article today by Ryan December. It's December with Z instead of C. Interesting. That was put out today, and his article was called "Energy Stocks Fall Faster Than Oil Prices." And what he's saying in the article is behind a paywall, Wall Street Journal subscription. I don't remember how much it is offhand, but what he's basically saying is that even though the oil price is down from, $70 a barrel at the end of last year, early 2019, down to WTI, it's down to, under 53 now. So that's not a 50% drop in WTI prices. However, he said in the article that 40 U.S. publicly traded oil companies, their share prices are down 50% or more. So these are companies with bad balance sheets that they have to maintain production because they either hedge the oil at a higher price and they have to maintain the production, or to try to make up the difference, to try to delay bankruptcy, they're trying to produce more oil to make it up on volume temporarily, betting that the oil price will rally. So if the oil price were to actually go lower, they would get in trouble. They would get in even more trouble. And the OPEC countries get into these problems as well, that it's counterintuitive. When the oil price falls, the OPEC countries, some of them cheat, even if there's production cuts and the quotas, and cheat on the quotas, cheat on the production cuts, and they will actually increase oil production to try, because so much of their government budgets are based on oil. Some of these countries like Venezuela and some of these other oil producing countries in OPEC, so much of their government budgets are based on just oil revenues. Crazy stuff, huh? So the oil company shares, 40 U.S. publicly traded U.S. oil company stocks, their stocks have fallen more than 50% or more, which is falling faster than the oil price has fallen in 2019. So that shows you that the overall investors are very, very worried about the balance sheets of a lot of these oil companies. Meanwhile, you have the CEO of ExxonMobil saying that ExxonMobil is making big investments into the Permian and shale oil, and they're saying that they see double-digit returns going forward. I don't believe it. It's very suspect. I suspect he's fibbing. Let me just put it that way. I don't believe him, because there's experts at Shale, and they're not getting consistent double-digit returns. The only publicly traded company that I know of that's consistently getting double-digit returns, investment on their capital in Shale, is EOG Resources. That's the only one. And they have free cash flow now. The last time I checked, last month, I'm not sure now, but they did. But the majority of other shale companies, they have massively over-leveraged balance sheets. I think EOG, this is not financial advice, just my opinion. EOG was really, they said they cleaned up a lot of the debt on their balance sheet, and they had like $300 million per year in free cash flow, which is not horrible. But, I mean, in a bear market like this, I am not bullish any oil. Okay, people are going to put in the live chat section, they're going to ask, like, are you bullish on anything oil? No. No, I don't want to be long any oil exposure. There are refiners that will benefit if oil prices stay at these levels or go lower, but the real world, the real economy repercussions, and we've seen tons of these stories about oil companies reducing their capex, reducing massive capex, and capex is capital expenditure, and this is key for resource companies. What that means for the average Joe or Jane working in the oil area or working at a restaurant or bar or shop around an oil area is you're going to get less business. Or if you're working on an oil rig, that means you could lose your job. So when a company massively cuts capex, that means they're not making reinvestments into growing production or upgrading or exploration or key things that have to be made to maintain property, plant, and equipment. And this is the problems that with a mine or a very expensive factory to retool, like in the auto industry, maintaining property, plant, and equipment, capex bills can get into the billions of dollars every couple years sometimes, depending upon how large the factory is, how many oil fields, how large the mine is. You know, a capex bill for some mining companies can get, it could be $100 million or a couple $100 million every few years. And that just destroys the margins. It destroys the free cash flow. This is why a lot of regular value investors will not touch a lot of resource companies because of maintenance capex, and there could be a surprise maintenance capex bill. And for companies to cut capex, that means, like I said, in the real economy, in the real world, that means that the oil workers, the service sector companies, some of the drillers, they're not going to get the work. They're not going to get the jobs. Now, the service sector companies that are doing the drilling, they may have to discount even further to get work, to get jobs. And if they're discounting, that means less margins, or they're drilling break even or at a loss. So it's looking like there's a lot of evidence now that there's going to be a big bust in shale in the next couple years. And in my opinion, a lot of it was done totally uneconomic. It was done extremely inefficiently. Over $1 trillion in equity shares and junk bond debt was raised for shale, and there was very little earnings, dividends, free cash flow, etc. to show for it. Bloomberg also released an article, a fairly in-depth one, in the last couple days. This was on October 13th by Julian Lee, and it's called "America's Great Shale Oil Boom is Nearly Over." America's second shale boom is running out of steam, but don't panic just yet. A third one may be coming over the horizon. I don't agree. I don't think a third one's coming over the horizon, especially because shale oil companies cannot raise capital, and they already have too much junk bond debt. So unless oil prices are going to rally, I don't think there's going to be a third one. So the U.S. Energy Information Administration published its latest short-term energy outlook last week and has cut its forecast of oil production by the end of 2020 for the fourth straight month. It now expects American output to rise by just 370,000 barrels a day over the course of next year. That will be the slowest growth in 4 years and is yet another indicator that the latest period of rapid shale expansion is faltering. The number of rigs drilling for oil in the U.S. has fallen in each of the last 10 months, dropping by a total of 20% since November, and productivity gains are waning. Drilling in the Permian, the most prolific of the shale basins, fell by 11% in the 9 months to August, according to the EIA, which is the Energy Information Agency, that I believe the U.S. they're inside the U.S. Department of Energy. And there's the international one. I think that's the IEA, International Energy Agency. That's the international one that tracks data. And the development, according to, also with the shale, let me just do this real quick before I finish the article, that there was a Fed study done in August, and Bloomberg cited the article. The Federal Reserve did a study that the shale boom had lifted GDP growth in the U.S. by 10% from 2010 to 2015. And again, let me add, that created a lot of jobs, and it did it without consistent earnings. It did it without paying dividends that were promised to investors, mostly sucker pension funds, and it did it without generating little, if any, free cash flow. Okay, so let me continue with the article. So, okay, according to the EIA, the development of U.S. shale patch is a bit like that of a person during the first growth spurt. In the 4 years to 2014, the industry was in the toddler phase. The industry, this is funny, they're comparing toddler phase because the industry had $100, I'm adding this is not in the article, the industry had $100 per barrel oil, and still, because they were learning how to drill these wells, and those wells were sweet spots, they still were not consistently profitable. The majority of publicly traded shale oil companies, although the shares were going up a lot. Okay, everything was new and exciting. The toddlers stuck their fingers, or in this case, their drill bits, into everything just to see what would happen, and they pushed the boundaries in every direction. The toddler developed quickly, but the outside world taught a hard lesson with the crash in the oil price in 2014. Well, this is because they brought on more and more oil production, and the Saudis, if you remember back then in 2014, the Saudis refused to cut oil production because the Saudis wanted to kill shale oil, and the Saudis were willing to go into debt and also to burn a good amount of their reserves because they thought for sure if they let oil prices go to $65 a barrel, shale would be dead within a year or two, that it would all go bust, and it did not. So the Saudis wasted a lot of money trying to kill shale. They wasted hundreds of billions of dollars of their own reserves back then trying to kill shale oil, and it did not work. I believe they're trying a different way. Eric Townsend of Macro Voices has talked about in the last year or so that there was weird trade setups throughout the oil futures curve. So that might have been the Saudis involved. The second boom from 2016 has been more like the adolescent phase. After picking themselves up and learning to live in their changed world, the young adults developed their muscles and concentrated only on the things that interested them. The sweet spots in the shale deposits. This is inaccurate. This article is inaccurate because the sweet spots were drilled first, with mistakes and inefficiently and not generating free cash flow. So the article is saying that the sweet spots were drilled later after they learned their mistakes. This is inaccurate. The sweet spots were drilled first, from what I've heard, in the Bakken and the Eagle Ford, to the exclusion of everything else. Now, the Permian may be different. The economics were the best in the Permian, I believe, of the Eagle Ford and the Bakken. But the Permian cannot grow permanently for the next, 10, 20, 30 years. I doubt there's going to be permanent growth there, especially with oil prices dropping. There's going to be a limit, especially when a lot of these oil companies are cutting back on CapEx. They're not going to be able to keep growing production if they're going to keep slashing their CapEx bills. So the focus has brought bigger output gains than the first boom. In the 3 years between December 2016 and December 2019, output is expected to have increased by 4.2 million barrels per day compared with 3.9 million barrels per day between 2010 and December 2014. That's because I think the Permian is probably better. It's a better field than the Bakken. The Permian's lower cost, I believe. The biggest challenges of the second shale boom have been identifying and exploiting those sweet spots, consolidating acreage to enable the use of longer wells, and building infrastructure to move the gas and liquids to markets. So there's tons of inaccuracies throughout this article because there is not the infrastructure to move the natural gas. There was not a lot of pipelines built to move the natural gas. I've heard many of these shale oil states in North Dakota, Texas, that a ton of this natural gas, it's actually in the state's interest, even if the people in the state are claiming they want good environmental policy. The economics are so bad for the natural gas, the byproduct at these shale oil wells, that a ton, just record amounts of natural gas is being flared because the natural gas price has not done well, and a lot of these shale natural gas producers are even worse than the shale oil ones, from what I've heard. So there's just tons of inaccuracies in this article, but hey, it's the mainstream media, right? So, and building infrastructure, blah, 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 liquids to markets. Yeah, there's not enough natural gas pipeline capacity. If there was more natural gas pipeline capacity, we wouldn't be wasting and having to flare as much natural gas capacity. But the problem is natural gas prices are not high enough to build the pipelines. So there's not the economic incentive to build the pipelines to not flare off the natural gas. So with the WTI price of about $50 a barrel, we're a little above 50, but okay. Some in the shale patch are struggling. Some in the shale patch, most of the people in the shale patch, I guess this person did not read any balance sheets. Shale companies are being forced to produce more to service their high debts, but they aren't making any surplus profit. They aren't making any profits at all. Surplus profit, any profits at all, to cut their borrowing or pay shareholders. Now those investors are starting to demand more of a return. With the crude price seemingly stuck close to where it is, despite the tensions in the Persian Gulf region, which flared up again on Friday, the next round of discussions between the shale producers and their lenders could be difficult. Some mergers may follow. Yet, fans of U.S. shale oil shouldn't be disconsolate. The end of the second shale boom will usher in a third, the period of young adulthood. This will bring a range of new skills, but production will grow at a more measured pace. I don't know if I agree with that, but I'm not even sure production is going to grow at a measured pace. This third boom, especially if oil prices keep falling, I don't think it's going to be accurate. If oil prices drop below 50, I don't think production will keep growing. This third boom will be driven by the international oil majors and will be characterized by a focus on better extraction rather than rapid output growth. The application of enhanced oil recovery techniques, consolidation of ownership, automation of drilling, and rationalizing of supply chains will increase the volume of oil extracted over the lifetime of a well and reduce costs, but it won't deliver the same pace of growth as seen recently. So this entire paragraph there is, in theory, the larger super major oil companies like ExxonMobil, they have more resources, they have some better geologists or better skill, and they may be able to be more efficient producing the shale oil and generating a profit and free cash flow. But the larger super majors looked at a lot of these shale deposits, and they didn't think that they could make money on them even at $80 or $100 a barrel oil. So now the large super majors think that they can make money at the lower oil prices. I'm not so sure, because they were looking at these deposits 10 years ago and they didn't think there was. I've heard stories with my oil industry context. There was a lot of people inside these large oil companies, and there was tons of warnings that, we can't make money consistently even at $80 or $100 a barrel oil. There's all these challenges. And, the wildcatters, the independents, did grow production, but they never consistently made the publicly traded ones. I have listeners to this program who run oil rigs who are not publicly traded companies, and they say that they can make a profit. The publicly traded ones have not consistently made a profit. The only one I've seen is EOG. So you have these factors. I'm not sure if I should even read okay, looks like the article's almost over. Claiming the recovery rate of oil from shale deposits is typically only 5 to 10%, but ConocoPhillips is claiming it can get as high as 20% in some parts of the Eagle Ford shale play in Texas. And now some people are claiming it can get up to 40% recovery rates on shale. I don't know if I believe that. I think a lot of the sweet spots in shale have already been drilled years ago. Go listen to my interview from about 2 months ago with Art Berman. He is a petroleum geologist for decades, and he called shale oil production the retirement party for the oil industry. He said that if there was better, more economic projects to be drilled and oil production, then they would have been done instead of shale. So I think this is a spin here from this article. And another thing about, so beneath the surface, there is a lot of problems in the oil market. The OPEC countries, a lot of them are not doing that well financially. Everyone knows now at this point about how bad things are in Venezuela and how messed up the Venezuelan oil industry is. But now Mexico, Steve St. Angelo of SRS Rocco Report covered this. I found this on his website in the last year or so. But now Mexico, which used to have the Cantarell oil field and used to be a massive net exporter of oil, they're now a net importer. It just happened in the last 12 months. They're now a net importer of oil. So that's something to follow. And this happens with a lot of oil producing countries, is they produce a lot of oil and they subsidize. So much of their government budget is based on oil, and social programs are based on oil revenues, and government budgets are based on oil revenues. And then the country subsidizes the oil for their own citizens in a lot of cases. And so the people inside the country are not paying a market price for the oil, and the amount of oil consumption just explodes. And then after 10 years or 20 years of massive oil production, with Mexico, I think Mexico's oil production increased massively starting in the 70s. So Mexico had about Mexico had about 4 decades of net oil exporting with their oil discovery from Cantarell, which was a massive super major oil field. They had about 4 decades of net oil exports, and they subsidized the oil, and oil was cheaper than it should have been. And after 4 decades of oil production, the oil field, they didn't reinvest enough profits back into the oil fields there, the Cantarell, to maintain oil production and, like all the capex requirements for properly running the business. And instead, the Mexican government used the revenues for running their government budget running their government budget and social programs and subsidizing oil for their own citizens, instead of reinvesting any of those oil profits back into the oil business. And now Mexico is a net importer of oil. It has switched over. This also happened to Indonesia. So Indonesia was, after first joining in 1962, it was a member of OPEC in 1962. It left in 2009 as dwindling oil production meant it had become a net importer of crude oil, which is against OPEC's statute for full membership. They then rejoined OPEC, I think in 2015 or 2016, and they have made several deals on crude imports, overseas upstream investments, and refining partnerships, including with Iran and Saudi Arabia. But Indonesia's crude oil output peaked at around 1.7 million barrels per day in the mid-1990s, and they've had very few oil discoveries in the past 10 years, and production has fallen to about half of what their old production was. So this is guaranteed that all this oil production, and the shale oil production, the main thing to understand here about the shale oil production, all this production growth that added to US GDP, that created a lot of jobs, it was not done efficiently at all. It was not focused on making a profit, making high margins, generating free cash flow, paying dividends to shareholders. Pretty much all the publicly traded shale oil companies, none of them did that. And so the investors now, 10 years later, if they've held that long, especially if they're a pension fund, because pension funds a lot of them are not managed very well, and pension funds put a lot of money into the shale boom. So if the oil price keeps going lower, there's not going to be the justification to increase oil production for shale. Yes, some of the producers are going to keep increasing production to try to delay bankruptcy, or if they have hedges at a higher oil price, they'll have to increase production. But the oil production is going to maintain at certain levels until some of these shale producers go bankrupt. More of these shale oil producers go bankrupt. It's not looking good. In a more rational market, they would cut production. All these shale oil companies, if they hadn't used debt, if they had better balance sheets, if they had better margins, if they had money in the bank, if they had more cash on their balance sheet, they would cut production and say, we're not producing oil at a loss or break even. We're going to wait to produce this oil after the bear market is over and oil prices start to rally. But that's not what's happening. So it's looking more and more, there's just more and more evidence, at least to me, that there's going to be a big bust in the near future. And the inventory numbers, those inventory numbers are very important for short-term oil prices. Because if there's a big oil inventory build in the US, it will not help prices go up. I can tell you that. Jesse says that red line looks like the Redskins ticket sales. I'm not a Redskins fan, so I think that's hilarious. Oh my god, that was funny, Jesse. Okay, so I think that's... Let me check the articles. I think that's pretty much it. So there is a lot of crazy stuff going on in the oil market, and if the oil prices go lower, it's going to get worse. I want to thank my over 170 now Patreon account contributors. It's pretty amazing. I might even be at 200 in a couple months. That's how good things are going right now. My almost a dozen monthly PayPal contributors, and the people throw me a tip once in a while. It's much appreciated. This channel, the YouTube stopped the growth of it. I think I added under 100 new subscribers in the last almost 6 weeks. It was growing at 2,000 new subscribers per month. Oh well. I'm making a living making the content, so if I'm making a living making the content, I don't really care if it grows or not. I'm doing my best. I don't have any control over YouTube's algorithm. I have control over making the best content possible. That's what I have control over. Yep, my Patreon account contributors have gone up more than fivefold in the last 6 months. It went from about 30 to 170. And that's because I do quality work, and unlike the people in the gold and silver community and the alternative media, most of them, I don't repeat myself. I don't repeat myself ad nauseum. If the information and facts change, my analysis will change. And the people who allow me to focus on creating the best possible content, they're going to get the best possible information. So it looks like the oil, it looks like we're going to have a very big bust. If the global economy data, the global macro data gets worse, that's not going to help the oil prices go up. If the inventory keeps building and keeps exceeding analyst expectations, that's not going to help the oil price go up. If the shale oil companies are they're hamsters on the hamster wheel, running faster and faster to delay or avoid bankruptcy, that's not going to help the oil price going up, because they're producing oil inefficiently and not at a profit, and they're just dumping more oil just to delay bankruptcy. That's not going to help the oil prices go up. Now, long term, there's a lot of problems in the oil market. There's a lack of discoveries and other things, but in the short term, almost all the evidence I see in the oil market, almost all the evidence I see looks like there's going to be a really big oil bust in the next couple years. It's possible. It's possible oil could go to 30 and then up to 190. I'm not saying it's likely, it's possible. Should you still get a hybrid car? Terrence Chung asks. It depends if you're getting a tax credit, and it depends how far you're driving. It depends if you live in California and you're getting robbed, paying almost $5 a gallon. If I was living in California, I might want a hybrid. Oil can't go down too much in dollars because US dollars are garbage. No, that's not accurate. It's supply and demand. If the shale producers flood the market with new supply and the global macro data is bad, and that makes people worry about demand, even though long term I haven't seen that demand has fallen massively yet. Actually, the funny thing about the long term demand is, according to the BP statistical review, the demand still goes up. Global demand for oil still goes up about 1 million barrels per day per year. So there's 1 million barrel per day increase every year. It's like clockwork, according to the BP statistical review, which is the most comprehensive oil industry. It's like the Bible of oil industry analysis and statistics released every year. It's massive. Okay, I'm going to take a look at listener questions and comments. I don't see anything in the super chat, so this will probably be pretty quick. IBJI says ExxonMobil stock price is breaking down, could drop to $60 easy. So ExxonMobil, number one, they've done a bad investment. I believe they bought XTO Energy at the very top. They overpaid for XTO Energy tens of billions of dollars. But the main problem with ExxonMobil, in my opinion, is that they've been doing share buybacks for over 15 years, massive amounts. So ExxonMobil has been they were doing tens of billions of dollars in share buy. Actually, ExxonMobil, the share buybacks it might be over 100 billion in share buybacks. It's a massive number. And for a cyclical business like oil, where the margins or free cash flow could massively drop, for them to do tons and tons of share buybacks and leverage the balance sheet with that much debt is very dangerous. But they did not want pension funds dropping their stock, so they wanted to increase dividends. So ExxonMobil, the past CEOs, like everyone says how smart and great Rex Tillerson was as CEO, but the truth is he did a ton of share buybacks, many, many billions of dollars of share buybacks when the stock price was at $90 a share, and loaded the balance sheet with debt then. So the ExxonMobil has lost a lot of money on those shares that they bought back and loaded the balance sheet with debt. I don't think Exxon thinks they'll get bailed out. Okay, this is an interesting super chat from Wayne. With all the focus on China and trade, why isn't there more focus on what China is doing with forced organ harvesting? So there's a free interview that Real Vision TV just released on their YouTube channel. It was behind a paywall, where Kyle Bass interviews retired General Robert Spalding. I highly recommend listening to the interview. And based on what I've heard from China Uncensored, and China Uncensored has good sources on this stuff, they're adamant that the Chinese government spends hundreds of millions of dollars and makes threats to Western media. So the mainstream media in the U.S., not only do a lot of them are they champagne socialists, and they gave Xi a standing ovation at Davos only 2 years ago. So they support a lot of what she says, and people like Ray Dalio get enormous tax breaks inside China for their investments, so he markets for them. And a lot of these billionaires now don't want they don't want any democracy anymore. They want to copy the China model and bring it here to the West. But what China Uncensored has been saying is that the Chinese government actually pays Western media and the mainstream media, specifically here in the U.S., the business and financial community, so like the Wall Street Journal and others, for positive media coverage. So all that stuff is left out. I believe there was a fictional drama TV show on CBS, like Good Mother. Oh man, I don't remember what that. China Uncensored was covering this a couple months ago. It was one of those drama shows, and they mentioned on the show, on one of the scripts, they actually recorded an episode and talked about the Xinjiang, the Muslim concentration camps with the organ harvesting and others, and the Chinese government found out before the episode was released, and it was removed from the episode. Or you have a situation with what happened with the NBA, where if you criticize China or you say anything pro Hong Kong, you risk and if you have business dealings inside China, inside mainland China, the Chinese government will threaten, even if you, look, one tweet. All Daryl Morey made was one tweet. And the NBA, China was threatening to totally take away all of the NBA's contracts there. Billions of dollars, potentially. For only one tweet from not even the president of the NBA. He was a general manager of one NBA team, the Houston Rockets. So all it was one tweet, and China, of course, retaliated, threatening to take away all financial gains. So that's why you're not going to get honest and objective and accurate coverage from the mainstream media. I mean, you're not going to get it even covering American news. Look at what James O'Keefe from Project Veritas just revealed with the CNN stuff. With the CNN Insider. Oh, thank you, Sean, for the super chat. Much appreciated. I'm still working on an interview with Kyle Bass. I have not stopped trying. I'm still working on it. I've been working on it for 6 months now. We'll see what happens next time he's in the DC area. No, I don't like Bannon, Matt. I don't like Bannon. Hey, Terrence, you're wrong. I don't repeat myself that often. I listen to other people. I used to listen to a lot of other people's interviews, and it's the same interview over and over and over from a lot of people. You get a lot of different information and analysis from me. So I don't think that's accurate. There was another story on Zero Hedge about net capital outflows out of China. I've heard from my contacts that there's a lot of People's Liberation Army generals and higher-ups in the Chinese military and other higher-up Chinese government officials that are scrambling to get money out. So even though the currency has been rallying against the dollar back closer to 7, none of the people with savings and capital in China trust it. Hello, Terrence. I don't think you know anything about Kyle Bass because he didn't vote for Trump, and he said publicly many times he particularly doesn't even like Trump. Kyle Bass is America first. Kyle Bass is doing this because he is America first, not because he likes Trump. In fact, I've heard many times from him, from someone who speaks to him daily, that he does not like Trump at all. I have not seen the 300,000 tanker article. Thank you for the super chat, Wayne. I have not seen it. Is this what the Wall Street investment banks are doing, storing oil on tankers again? Yeah, if you haven't listened to the interview with Kyle Bass and General Robert Spalding, and if you don't know who Spalding is, he was, I believe, the U.S. military ambassador in Beijing for years. So he speaks fluent Mandarin, and he was talking about his experiences dealing with the Chinese government and the Chinese military when he was ambassador over there in Beijing. Oh, another Nats fan. Well, they may do it. We'll see. I was one of the few people that actually thought they had a good chance to beat the Dodgers. The Dodgers are actually my favorite team, and the Nats are my second favorite team. But when I was objectively looking at both teams when they played each other, none of the other experts or analysts thought that the Dodgers had any weaknesses. And if you actually watch Dodgers games, their main weakness was the bullpen, and you saw that in the divisional series. The Dodgers bullpen got exposed. Nationals need to be steroid tested. The Nationals have stolen base guys. That's funny. Yeah, and then the Dodgers bring... look, I love Clayton Kershaw, but announcing that you're bringing him in out of the bullpen, trying to get hitters out in the strike zone, throwing 88, 89 miles an hour, you're not going to get hitters out anymore. Throwing balls in the strike zone. Throwing pitches in the strike zone at 88, 89 miles an hour. He doesn't have the power stuff to challenge hitters like that anymore. And he shouldn't be coming out of the bullpen. The Dodgers bullpen was a mess. And I'm a Dodgers fan, but talking with other Dodgers fans about that before the series started, no one wanted to hear that. before that Dodgers Nats series started, other Dodgers fans were like, "Oh, we're gonna whoop them. It's gonna be so easy." And I was like, "No, the Dodgers bullpen is just as bad, if not worse, than the Nats bullpen." Other Dodgers fans did not want to hear that. Yeah, the Dodgers have, well, this is going to get off topic. Some people are going to put thumbs down. I should maybe do a separate baseball channel. I know an enormous amount about baseball. I actually spent more life learning about baseball, practicing, training for baseball than I have with finance. Okay, well, that's it for right now. If you want to talk baseball, maybe we should do that on another separate podcast, on another channel. I could maybe do something separate. People have been saying, some of my friends have been saying I should do a show like that for a while. I'm not sure if there's that much economic benefits to that, but maybe just for fun, that's something I could talk about in the future. Okay, everyone, have a nice night, and I will work on more content in the next couple days.